afternoon, ladies and gentlemen. Welcome to today's quick illustration. Just for a disclaimer, um, I'm not a financial advisor, I'm a financial professional. My job here today is to illustrate to you how you can roll your money over from 401k to index annuity. Now, when I get to the illustration side of it, I want you to also understand that this illustration was designed based on the history or the historical performance. So that being said, I'm gonna go ahead and start the illustration and just to also make this quick note. I chose Silac Annuity uh, company just because that's the company I want to use to illustrate this rollover from 401k to index annuity, from Roth IRA to index annuity, all those qualified plans that you know, even IRAs to index annuity. I choose to go with Salak Annuity Company. Nothing too um, crazy about it. I'm not marketing their company. I'm just using the illustration just to show you how rollover works and how you can take advantage of this rollover 1035 exchange without paying any taxes to IRS when you use that tax code. Internal exchange or external exchange 1035 rollover to index annuity. When you do that, you're actually securing your retirement. We already know what's going on right now in the market. Market goes up and down, volatility. So you tend to lose money in your retirement. Now, you see a lot of people lose money in their retirement account or vehicle when they get to age of 65. They have no choice than to stick with their job because when they look at their portfolio, their accounts, the money they have in their account is not enough. So they chose to go back to work. But these are people that are supposed to retire and also earn what we call a lifetime income, But because of how you lose money in your qualified account like 401k, IRA, Roth IRA, you see all those money market accounts, it creates that fear, anxiety of how am I going to retire when I don't have enough money saved. So we are here today. We are trying to eliminate that fear. We are trying to show you how you can avoid that fear, that anxiety, that depression, that mistake. It's never too late. So I'm going to jump into the illustration, and after this illustration, if you have any question, you can book an appointment with us. We'll show you how it works more, explain every single details for your full understanding. All right, let's go. Um, I'm gonna go into Salak Annuity. This is the illustration software. I'm gonna go in here. So this is just an illustration, which means we can use anyone. We can use you. We can use any age. Okay. So I'm gonna put the agent's name here. Gochuku is okay. Then the state. You know, I'm going to select Connecticut. The product. I'm going to select. Um, so based on this particular piece, now let me say it this way. When I have a client, I ask my client what are they looking for. Some clients are looking for retirement. Some clients are looking for accumulation. They want to accumulate more money. Some clients are looking for annuity or retirement that will guarantee them life income. So all these products you see here, list of products you see here, these are different products according to the client need. That's why, as an agent, before you do this, you help a client, you need to understand all these products very well to make sure it is suitable for this client. Because if you don't do that, it's actually against the law. So you need to get your suitability training before you can be able to do annuity business for any client. So that way you understand the product you're helping your client with. Because remember, these are people's money that we are trying to roll over. We want to make sure their retirement is put in the right portfolio. Now, I selected the Nali 14 for this particular case. I'm going to put the client's name, let's say Miss Elizabeth, right? Now, owner's age. Miss Elizabeth, she's 43 years old. Um, she has $30,000. Now, let me just put it this way: some people, when you leave your job, some people move from one job to next job. Now, when you leave your first job, say company A, even though you're not yet 59 years and a half, you can roll down your 401k or your retirement money in that company, you can roll it over to annuity. Now, the law says you cannot access your retirement funds until you are age 59 years and a half. Now, there's an exception. The exception here is if you move from one job to the next job, you can actually roll over without being taxed. That's number one. Then number two is if you leave that money in the other company, remember when you used to put money, or should I say contribute money, these companies promise to pay you 3 to 5%. They match those contributions, right? Now, when you are no longer with this company, do you think they will continue to be your matching the account? No. What are they going to match? They are matching whatever you are contributing, right? So when you leave your job, it's very, very important that you roll over your 401k, your retirement account to index annuity to safeguard your retirement funds. Okay? Now, Miss Elizabeth, she has 30,000 with company A. She moved to company B, and when I spoke with her, I tried to explain to her how she can also roll it over, and she was very excited about it. So we are rolling this money over from the qualified account, 401k, Roth IRA. These are qualified accounts, right? IRAs. These are qualified accounts that you can also roll your money over. There are different types of retirement accounts. You have the 457, you have TSP, depending on um, 403B, depending on your company or where you work for. Now, what you're seeing here is an allocation. All right, this is what we call allocation. At the end of the year, right, how much percentage will be used to multiply whatever you have. These are the performances in your account, right? For example, most of us know about S&P 500. Most of us know about Nasdaq. So these are different credit crediting strategies, right? Or should I call it the investment strategies, right? So I have done my own due diligence, but for the purpose of this illustration, I'm going to show you how I how I'm able to help Miss Elizabeth set up this rollover account. Now I'm going to be selecting 50% for Credit Suisse. Now, um, diversification is very, very important, right? Diversification is very, very important. So, so I chose that one. I'm going to spread it across. The goal is for you to spread it, uh, um, for you to have up to 100%. That's the goal. So I'm going to select another one, S&P 500, right? So if I select S&P 500, uh, my goal is to um, my goal is to do what? um, spread the performances. So in this case, I'll do 25%. Now we need one more 25%. So let's see. So the second one is backlinks, right? So now the third one is Nasdaq Generation 5, point to point with participation rate. Now I'm gonna show you the performances. So these things are not done on top of my head, right? I'm gonna show you the performances so that you see how we do that. Remember, we select all these strategies based on the historical performances. For example, when you go to doctor and you are about to carry out a surgery on you, the doctor will say, according to history, according to statistics, according to this, that's a reference that 90% of our clients that they performed surgery, it was successful. 5% wasn't successful or have some complications, right? So now the same thing applies here, you know. So we are giving you all this information based on the history, based on statistics, you know, and it's accurate information. Okay. Now, one thing I have to also stress for you is you do not lose money in your index annuity. Now, why is this so? The reason is that index annuity uses an index crediting strategy or uses index strategy when it comes to how your money grows. So that means you will never lose a penny. There will some company will guarantee you zero floor. That's what I call a floor. That's what we call a cap. So a floor is zero. Most company will give you zero, which means at a certain condition where, for example, market crashes beyond repair. Take a for instance, during the year of 2008, the market crashed heavily, almost minus or negative 20 something percentage. Now, if you have your money in your 401k, all those qualified accounts or money accounts, money market accounts, what do you expect? You're gonna lose so much more money in those accounts. But that's what we are trying to um, avoid those depression. We're trying to avoid those anxiety. We are trying to avoid those mistakes, those losses against your retirement. You know, so that's why we want to roll your money over to an account that you will never lose a penny. Okay. Now I'm going to run this. Now, if you take a look at this, you see type of withdrawal. So Miss Elizabeth, her goal is when she retires she wants to have a lifetime withdrawal. Okay, that means lifetime income, stream of income. Now, Miss Elizabeth, um, she's 43 years old, right? And that means I'm trying to select how many years would it be for her to be 65. Withdrawal start uh, year 22. So if you add 22 plus 43, her age, that will give you what? 65. Now, when do you want this withdrawal to end? You know, you can withdraw to 80 years old. You can withdraw to 100 years old. It's personal actually. So in this case, when she's 65, she'll start withdrawing. She wants to stop at age of what? 95, right? Now, if you add um 30 years plus year 30 years plus 65, that will give you 95. So she wants to stop at 95. And also, you can also say, okay, you know what? That's no problem. Let's run it till what? Year 100. Some people will say it's not realistic. But remember, like I said, every client we meet every single day, their case is different. Their case is different. Okay? So it's not something that is like how I say it, is fixed. No. This is a very flexible um very flexible product. Okay, it's a very flexible product. All right. Okay, let's go. All right. So all right, let's see. So go to the next. Okay. So in a nutshell, this is what we have so far. All right. So we have a quick summary. She put in 30,000. Okay. So now let me explain to you again. Now remember that I told you about the allocation. I'm not gonna waste much of time on this, but we can do this when we schedule an appointment. So Barclays Atlas 5.4, we have we selected 25% to be allocated using this strategy. So this strategy has is performing to 80%. You see that? It's performing to 80%. That's the current adjustment. And the minimum adjustment is 10%. Do you see that? Okay, great. Now let's go to the next one I selected. So I selected Credit Suisse, right? Raven Park, annual point to point. It's 300%. That's the current adjustment. The minimum adjustment is 10%. You see that? So I just want to show you. Now the final one is what? Nasdaq Generation 5 point to point, 25%. The current rate is what? 290%. So we go with the historical performance. Now, let me show you this graph, right? Now, this graph, you see that this graph is not going down. The line on this graph is not going down. What does that mean? So that means that your account will continue to grow, right? It will continue to grow. It will continue to go up, up. Now, um, when you see, let me show you. Let me show you something real quick. You see, let's take a look. Let's take an example here, right? Let's take an example here, right? You see, at this rate, what this is saying is what this is. This is a flaw, meaning market crash so bad that it's in negative uh, values. So if the market is crashing zero, beyond zero, so within this account, it guarantees you zero. What does that mean? You never lose any penny in your retirement fund or account. So that's why I try to highlight this so that you understand how this um, graph or how this performance is works. Now, if you go down to this table, remember, like I said, this is an illustration, right? This illustration was designed based on uh, historical performance, right? We is it gonna be built like this? Um, I won't be able to answer the question. And the reason is because every single year there is a way the market can fluctuate or perform. But based on the average, based on the historical performance, this illustration was generated, right? So this value was generated based on those historical performance. So I want to also stress that very well. But what I can guarantee you or tell you is you will never lose your money. That's the guarantee. Okay, now let's go. You put in $30,000, right? Now we have. Let's go and let me show you more about this real quick. So on the table here, right here, you put in 30,000, right? $30,000, right? Now, uh, remember the year of age 65. Age 65. Let's take a look again. Let's take a look again, real quick. This, I'm trying to show you something real quick. So this is the interest. This column is the interest credit rate, right? So 31%, 27%, 2.4%, 7.91%. Now take a look at this is where I want to make my emphasis. You see that 0%, it will never go beyond zero. Okay? It will never go beyond zero. That means it is a guarantee of something that is guaranteed. You never lose your money. So based on this, when Miss Elizabeth retired at the age of 65, she has $44,000 to withdraw annually. Then next year she has 53,000 to withdraw. Then at the age of 69, she has 68,000 every single year. Now you can divide that by monthly and tell me what it is. So you see, as time goes on, this is how much she will continue to withdraw until she's age what 100. Okay. Now, sorry, I made a mistake. Let me correct this again. It's two ways anyway. It's not really a mistake. It's two ways. So this is annual withdrawal. This is what we call lifetime withdrawal. Okay. So depending on the one the person chooses to go with. Okay. All right. So now let me also stress this also because some people will say, what about the guarantee? Yes. What I showed you first is non-guarantee. The table I'm showing you now is guarantee. Now, what is guarantee? Guarantee means now if market is crashing, let's say market crash this year, negative 28%, because you have index annuity, you do what? You do not lose money in your index annuity. Market crash again next year, negative 10%. If you have money in your index annuity, you never lose your money. It's zero. Next 3 years, negative 5%. Your account is zero because you're not losing any money. When I say zero, I mean your money is intact. You're not losing any dime in your account. Okay? Now, but this is the question now, okay? This is the question. Is it possible, as someone that has lived on earth for 20 years or 30 years or 40 years or 50 years, right? Is it possible that the market will crash every single year at 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 a stretch for um say 5 years or 10 years or 20 years? Now, if you take a look at historical performance, you will see that market never crashed like that. It's impossible. But the reason why government want us to show these guarantee policy values so that you also see understand what it's all about in a situation where market crash zero, zero like negative, 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 negative. But because this account is an index account, which means you never lose money in your account, so government is trying to let us, the professional, to show this illustration to our clients that you will not lose money in your account. But if you take a look at the withdrawal, you see annual withdrawal rate will change because you are not making money, but you can withdraw 1,831 dollars every single year. Okay? Now, if what I said makes sense to you, that means you understood it. But if it doesn't make sense to you, I will also encourage you to do what? Book an appointment so that we can also explain further at no additional cost. Okay? Now, take a look at this. You roll over $30,000. This is how much you were able to withdraw when you retired. Okay, based on guarantee. Say market crash from day one, you put this money, you roll it over till 100 years old. Market crash continuously, never lose money, but market crashes like crazy, right? That's what happens. But at the same point, just to prove to you that in this account you don't lose money. How can you put in 30,000 but you withdrew additional of 35,000, which is $65,000 in total? How is it possible? Very simple. Because this account, you don't lose money. You don't lose anything. Okay? All right. Now, let me go up real quick. Um, we are coming to the end of this episode or this illustration, but I just want to point out something real quick for you. Um, like I said, every client we meet every day, we ask some suitability questions to make sure that the product we are selecting or recommending for them is suitable for our client. Now, if you take a look on this page, you will see that um, it says here this annuity contract comes with a number of guarantees built in. These include an annual fixed rate of interest that is declared each year, minimum guaranteed interest rates, and a minimum value. So what it's trying to say is everything has already been built in. So this includes the annual interest rate that is being declared any given year. Okay. Now, accumulation means to build. You are trying to accumulate money and trying to accumulate cash. Further. Like you want to accumulate cash, depending on your goal. But what we're saying is it has an accumulation potential to build more funds for you. For example, you roll in over 30,000, you were able to withdraw 65,000. That's accumulation potential, right? Now, another advantage here is uh, protection um, against market upside down. Okay, protection against market upside down. So what it's trying to say is, in the situation where market is crashing or something is happening, inflation or all those things, you will never lose money. Now, we all are aware of what we call a fine print. I am very good in fine prints because I don't want something my client will get and tomorrow they will have what I call a buyer's remorse, or they will not be happy about it. We we have helped so many clients. They are so happy about it. Now take a look at this point. We are very um, transparent. We make sure our client is everything is being explained to our clients because this is their life. They work so hard to earn this money in the retirement account. So we want to make sure their retirement is safeguarded, right? So take a look at this place. It says the minimum interest credit you will receive is what? Zero. You will never receive anything minus, negative as you have in your other accounts. For example, stocks, cryptocurrency, 401k, IRA, Roth IRA, all those accounts. You never see any negative with the index annuity. Okay? So this is a fine print I want to show you. Okay, we already know what they call tax before. I won't go into that. Now, this account also comes with what we call um, death benefit. Right, in a situation where Miss Elizabeth passed away, this can be um, this money will be sent to what the beneficiary without going to probate court. It's free from probate court. Right now, I just want to share this information with um, you guys real quick. And if you have any question down the road, that would be great to answer your question if you book an appointment. And like I said again, we have cash value, free withdrawal charges. I will go into details to explain all these things to you. It's no rocket science. It's every fine print there is self-explanatory. As a professional, I will make sure that you understand all these, um, what these fine prints are saying. Um, Now, if you go here also, you see lifetime withdrawal. You see wellness withdrawals. In a situation where I want to stress this also very well. In a situation where, in order to qualify, you or your spouse must now be able to perform at least two of activities of daily living. Now, what is activities of daily living? If you cannot eat, you need help. You need help. Need help with taking shower. Someone needs to give you shower. Only two. Or you need help dressing up. You cannot dress yourself up. Or you need help mobility. Someone have to put you in a wheelchair to walk you around. That is activities of daily living. Two, or you are incontinent. If someone need to change you, like we see most of our loved ones in nursing homes, they need maximum or support, to make sure they are happy and their life, is not stolen away from them. We are supporting them, helping them in one or two things, one of the activities. So these are the activities we're talking about here. If you cannot perform only two, you're not saying it has to happen to everything has to happen to you. No, it's only two. That's when it will trigger that wellness withdrawal. The money that will be given to you, you know, every single based on the withdrawal setup. Okay. Now, at this point, I want to thank you guys so much for um, watching. And if you have any question, please try and do so to um, schedule an appointment. One of our financial professionals will reach out to you, schedule an appointment. We'll be able to help you roll over your retirement um, funds to index annuity. Thank you so much for being here today. We look forward to see you again in the next episode. Have a great day.